G'day folks, welcome back to another update for natural gas. Now the charts have broken an edge slightly higher since our last update. We're going to include some back testing and talk about some divergence that may be happening. Before you go any further, make sure you hit that like and subscribe button to support the channel and reference the +1 videos where you can do a deeper dive in some of the trading strategies we cover. In terms of the outlook, natural gas markets remain tight going into the late 2025 as demand has slowed in Asia and Russia's pipeline deliveries to Europe have largely ceased, forcing Europe to rely more heavily on LNG imports. Although new US and global LNG capacity is coming online, supply growth is still constrained and geopolitical tensions, especially the Israel-Iran conflict and a threat to the close of the Strait of Hormuz, are fueling price volatility. The phase-out of Russian piped gas underscores Europe's pivot to diversified LNG sources, with vulnerable states like Moldova particularly exposed to supply shocks. So starting off with natural gas on the weekly chart, we always look at the trends above the moving averages, and you can see there the price is well above the moving average, although this week so far it's a bit of a red candle. The CCI likewise is still above its respective moving averages, and it could be a slight pullback. Now we go to the smaller time frames to see what's happening in terms of micro moves. Now there's no divergence currently in play on the weekly. Going to the daily chart, it's gone a bit higher since our last update on that dotted line there, edged slightly higher to a new resistance at 48.15. You can see there the last few days of trade it's pulled back. The CCI has already pulled back below the moving averages. Doesn't mean it's going to crash, it just means we might see a bit of a retrace. Now, if you're trading on the daily, remember we always go in the direction of the weekly time frame. If you're trading on the daily, and if you were doing so, you would have got in at that break above the moving average of the price and the CCI when it's a fresh breakout, and you'd be closing it out on that first red candle just below that resistance. That would have been your exit point according to the daily trend on those moving averages of the CCI. And going into the 1 hour time frame, if you're trading on the 1 hour, remember we're going in the direction of the daily. So at the moment you'd be going long only, and at the moment you can see the hourly is in a decline, so you wouldn't be going short until you see the daily also going short. So at the moment the moving averages on the price and the CCI are in a decline, although notice both price and CCI, the price is touching the moving averages, the CCI is actually broken through, and we're going to wait to see what happens before we go any further to the long side. Again, we'll wait for these to break higher to go long, so long as the daily is also in a long momentum. Now in terms of the back test, going back to the daily for a moment, you would have started going long on the hourly from that point there when the CCI was above the moving averages, and so was the price in an upswing. You would have avoided going long during that period. That would have been your short positions. And on the back test going from that period, we go to the back test there, and you can see that during that period you would have been following the hourly trends. Now notice whenever you see a bearish divergence, you're getting ready to exit the trade. And here you can see the moving average of the price still in an upswing, and eventually the bearish divergence took effect and you would have got out of the trade, at least at the very latest at that point there. You'll notice as well I use average down so long as we're moving in the same direction as the daily, and you average down every time you get an opportunity with a bit of a retrace to average down on your contracts. But at the very latest you should get out of the trade, no matter how many contracts you've got, when you see the moving averages starting to swing down in accordance with these bearish divergence. Here we had a bullish divergence, and again going long, you would have gone long at the close of that, at the start of that upswing there, and you would have got in there, and that way you would have avoided that drawdown on your account. Going long, and here you would notice the bearish divergence, let it go long until you would have closed out at that point there when the moving average of the price started to swing lower, according with that bearish divergence. You might have got in there with a couple of contracts and then got out of it again at that point there. Again, notice the bearish divergence completing at that point. Then you're in a decline, and you would have avoided that drawdown. Going long again there, and so on. And at the moment, as I said, the last position you would have got out of would have been somewhere in that range there. No contracts open, and you probably wouldn't be going into it at the moment. You might have got in 1 or 2 contracts at that point there, but again, as soon as it breaks to the downside, you might have got out with a small loss. With a decline. Notice the CCI was declining. That's always a warning sign. You want to make sure the price and the CCI are in an upswing to go long. For BOIL on the weekly chart first, you can see there we've been in a decline for a number of months now, and it's finally broken into that moving average range of the price. So if you're going short, you'd be closing it at the very latest The CCI is a bit hard to see there, but the CCI is also in a bearish momentum below the moving averages. So at the moment, bearish momentum on the weekly. On the daily, it's actually broken above the moving averages. So if you're trading on the daily, you want to make sure you're going in the direction of the weekly, but in this case, you can see there it's broken above. And if you're trading on the hourly, you're going long during this period. Now, it's been a bit of a roller coaster in the last couple of months actually. And I've got an arrow here where you theoretically would have started going long when the CCI was in an upswing, and so was the price. And on that, let's go to the 1 hour time frame. And you can see there, we had a bit of a bearish divergence at that point, more recently since our last update. Slightly lower highs on the CCI versus higher highs on the price, and that's pulled back. And if we draw a Fibonacci range, we take it back to the significant low. Probably at that point, it's well below the 23-38% range, but even at that level there, it's broken below our minimum range. 23-38% is our minimum. And this looks like it's going to fall further on the hourly. So again, if you're going short, based on you want to wait for the daily to break to the downside to be more confident, like it did back here, to start going short. To go short now on the hourly is a bit dangerous, only because it could start retracing to the upside because you're still in a bullish momentum on the daily. So you want to make sure you're trading in the direction of the higher time frame. Now, if you look at the back test going long during that period, according to the daily, the back test here on the hourly, starting from that point around about the 27th of September, a bit of a roller coaster. And again, same principle, going long when an upswing on both the CCI and the price, closing it out when they break to the downside. Avoid trading short, going long again, closing it out. Avoid trading, going long again. In this case, you would have stayed in the trade probably till about that area, and then started going long again as well, until you notice that bearish divergence, and you would have got out of the trade somewhere in that range there. So for KLD on the weekly, that's below its moving average of the price, so it's bearish, and so is the CCI, so bearish momentum on the weekly, which means you go short on the daily if you're trading on the daily. On the daily time frame, again, you can see there, you would have started going short from that period, ideally. According to the weekly, you would have closed it out when the CCI broke into that moving average range on that candle. You might have had a break even or a small loss on that little trade, then going short again at that point, and you'd be closing it out in the current day if you're trading on the daily on that candle because of the CCI is touching that moving average range. Now, if you're trading on the 1 hour time frame, you'd be going short according to the daily here, and on the 1 hour, again going short during this little period, and same sort of principle: short, avoid trading and closing it out, short, closing it out, avoid trading, short, closing it out, and avoid trading at the moment. And this is how it looks like on the short positions on the back test. Same sort of principle. You could have averaged down a couple of times there, and that's basically the strategy we use. UNG on the weekly, that's broken above the moving averages. Bullish momentum, so is the CCI, and that was an effect of this long-term bullish divergence, higher lows versus lower lows on the price. It's a bit hard to see, it's very constricted, but there is a bullish divergence there, and that's starting to break higher at the moment. Again, we don't know how far it's going to go, so don't go trading the bullish divergence. On the daily, that's also bullish, but notice it's actually broken into that moving average of the CCI. So if you're going long on the daily, you want to be closing it out on this candle so far this week, on this day actually, to take advantage of that, because if it starts falling further, you might see the price also fall further. On the 1 hour time frame, that's already broken below the moving averages. But again, you want to wait for the daily to settle. Ideally, to start going long, you want to see the daily break higher on the CCI. Likewise, in that case, the price would start to bounce higher as well. Otherwise, if the CCI keeps falling and the price keeps falling, you want to wait for them both to break below the moving averages to then start taking short trades on the hourly. It's a bit too early to start taking short trades. You can do it, but it's a bit of a risk. You want to make sure you're trading in the direction of the higher time frame. So on the back test, going long from that period, from this period here, you can see there, and you would, again, same sort of principle, going long with both moving averages in an upswing, closing it out when they start both to turn down. Avoid trading on the short positions there and going long again during that little upswing and closing it out again. To take advantage of some bullish share scans, we do keep a portfolio of some shares we've covered in the previous weeks, and these are some of the trades we've closed since the 21st of September this year. These are all closed trades, and we've reaped 12.48% return since about a month and a half ago, so not too bad a return. To get advantage of that bullish share scan, if you've got the means, subscribe to the Patreon page, links in the description below. We publish that on a weekly basis. Hit that like and subscribe button. Thanks for watching, and we'll see you in a future update.